Good afternoon. My name is Andrew Shohet. I'm part of the Ocean Industries division at D&B. It's my pleasure to be up here with Quintin Kneen, the president and CEO of Tidewater. I'm confident Quintin doesn't need, or your business, doesn't need much of an intro here at Marine Money. But maybe just briefly, Tidewater is the world's largest offshore support vessel operator with a fleet of over 200 vessels. Quintin has been with the business since 2018, joining from Gulfmark, where he was formerly the CEO. Before we kick off, I just want to echo some of what my colleague Ted had to say. We are at D&B quite grateful to Jim, to Mike, to Matt, the Marine Money team. This is a great event, and just judging by the receptivity on the opening day here, it looks like it's a great agenda. So looking forward to discussion. Maybe just to kick things off, Tidewater has been a leading consolidator within the offshore space. So I want to start perhaps by rewinding back to 2018. Quintin, since then, you guys have executed on several M&A transactions. Can you talk through perhaps some of the high-level rationale behind some of these transactions and sort of what has enabled you to be so successful?
Absolutely, and Andrew, it's a pleasure to be with you here today, and thank you for the invite from Marine Money. You know, if you go back to the 2018 acquisition of Gulfmark Offshore, I would say that one was facilitated more by the fact that both companies, both Tidewater and Gulfmark, were restructured properly. And from my perspective, what that means is that they came out with a reasonable level of gross debt and essentially no net debt. So it allowed those companies to buffer any cyclicality that would come around, but also facilitated the ability for those companies to merge. And so from my perspective, if I take us back to 2018, the pandemic wasn't here. We were working through the oversupply in the industry for the past 5 years, but still weren't quite there yet. But we were definitely seeing utilization levels increase. And by the end of 19, which was after the transaction was accomplished, we were starting to get some day rate traction. But because those two companies came out restructured well, it allowed them to both combine and facilitate their, what I would say is a complementary geographic footprint. So that particular combination to me was a little bit different than the latter two. So you transcend 2019, things were getting slightly better. Obviously the pandemic hit in 2020. And I think there was a sentiment at that time within the broader offshore space that, oh Lord, here we go again. I mean, there were people literally throwing in the towel on their investments because they just weren't ready to go through another downturn. Like they saw a glimpse of a recovery, and this just really took the wind out of the sails. And so in that situation, what we were really betting, it was really just betting that the industry wasn't going to go away, because we were able to get those vessels at a very good discount. And so to me, it was less about the condition of the boats or even to some degree where they were located, but we got them at such a good price that I knew that we could structure them within the Tidewater framework and really take advantage of it. So we were able to do that both with the Swire transaction and the Solstad transaction. Now, in the earlier two transactions, the other thing that we did, because we were still very early in the offshore recovery, is we essentially did them all equity. But I wanted to make sure that they were relatively priced properly so that it was still very accretive to my shareholders. And so in both those deals, there was a little cash involved, but not much. And we quickly generated enough cash from the business to get back to net debt zero. So we did the Gulfmark transaction, borrowed a little bit of money. I think it was about $90 million on that one. Got it back down to net debt zero. Did the Swire transaction. I think it was about $70 million in cash in that particular transaction. Got it back down to net debt zero. But when we did the Solstad transaction, because the offshore recovery had demonstrated itself well enough, and there was enough contract coverage in the acquired fleet, we went all debt on that transaction. And of course, we're still, in the process of working ourselves back to net debt zero on that transaction, but it's also working out in that way. So different times of the industry recovery, different perspectives at the time those transactions were done, and also different transaction consideration.
So two of those deals, I suppose, were done in kind of the past 24 months, let's say. With any kind of M&A deal, I think integration is sort of one of the potential challenges that you face. How have those processes gone relative to kind of pre-deal expectations with regards to synergies? Has there been any kind of major learning lessons as you've sort of worked through those processes?
Absolutely. Every deal is different. And so I always caution my team and anybody that would like to listen that every transaction is unique, and you've got to approach it from the perspective that from the perspective of what could go wrong in this particular integration, or what could go wrong in this particular transaction. In the transaction with Gulfmark, one of the things that Gulfmark Offshore did well was that it had created a very scalable shore-based footprint. Gulfmark was always had fewer vessels than it should have for being as geographically spread out as it was. So in order for it to survive, it had to develop a very scalable shore-based infrastructure. And so when we did the integration with Tidewater, it was really about taking the Gulfmark shore-based infrastructure and technologies and bringing them over to the larger Tidewater base. So that took us a couple of years, but we were able to do that. I'm very, very happy with how that went. It was difficult because every transition is also a cultural and a behavioral transition as well. And so there was a bit more of that in the Tidewater Gulfmark deal. And so from that perspective, I was very happy with it. It was more of an integration of the acquired company's infrastructure, and that took us about 2 years. After we got that one done and we started focusing on the Swire transaction, that was one where we already had the shore-based infrastructure, so we just had to get them onto the existing business. And that transition was difficult because of the fact that we took on a business. So we took on an operating business with all of the individuals and the shore-based staff. And we, the numbers are going to be a little loose here, but I think we started with about 130 shore-based personnel in Singapore, and we got it down to about 30. So we really reduced the headcount. That's where a lot of the synergies came from. We were able to do that for a number of reasons. One is because we had a scalable shore-based infrastructure around the world, where we took vessels on in areas like West Africa or even Brazil, we already had an existing footprint, and we had the scalability just to drop them in line. We did have to create and establish a new office in Singapore, but that was part of that process. But anytime you bring people on and have to let them go, that's very tough. Singapore is a very strong job market, so it was very acceptable. We were able to make arrangements with most of the employees that allowed them to continue to be successful in their lives. But that's always a big part of the drama in that. Now, on the Solstad transaction, that was really an asset deal. So we essentially didn't acquire any people, but we acquired all the boats. That has its own challenges. And we had to make sure that, because when you're doing that, you're essentially taking each boat offline for 2 days, changing the name, changing the operator, making sure all of the legal documents are moved over, getting the systems on board that vessel and so forth, transferring the employee group and things like that. So the offshore employee group. And so that has its own challenges. So every transition and integration is different, and I never want to fall into the mindset that we can do anything, because I find all of them very challenging.
So if we fast forward to today, and the current cycle, as you know, I keep the credit hat on, but I think even for me, this cycle feels a little bit different. What, in your view, makes this cycle different as compared to previous cycles?
Every cycle is different, absolutely, and you have to look for those attributes of both the supply curve and the demand curve and how they interrelate in order to best determine how you're going to make your investments into that cycle. The factor that has the most influence on the cycle is the degree of oversupply. That is the most difficult thing to change in the short term, and we've seen it. We've seen it play out. When you get oversupplied, and just for the group's benefit, as we got into the end of 2014, we were oversupplied with vessels on the water by about 5 to 10%, and we had 20% of the on-the-water fleet on order. So there was just more vessels than the industry could ever sustain. And these are long-lived assets, and they take a long time to correct. And we went through that. And as I was talking about earlier, we seemed to have scrapped enough vessels, and things had deteriorated enough for lack of investment. So by the time we got to the end of 2019, we were starting to get in balance. And then we went into the pandemic, and that sent in another wave of shrinking the on-the-water group. And since then, since 2014, absent some news over the weekend, there really hasn't been any significant ordering in the PSV order book. And as a result, that's been great for us, because it's very easy to show people that, hey, the cycle and the supply aspect of the cycle is what takes a long time to correct. So when there's absolutely nothing on order, people have a really good sense of what the visibility is in the industry over the next 2 to 3 years, because that's about the construction life of a boat. So that's been very constructive for us. But to me, the supply piece is very important. Now, demand, of course, demand interrelates with supply, and we all know that. But it's usually just around the edges, just as at the end of December timeframe, Saudi Aramco announced that, hey, we're cutting back on what essentially were FIDs that they had made, which is not common, and certainly shocked the market too. And they had gotten to the point where they felt that they were had overcommitted to future production, right? And anytime you have that sends a signal to the financial markets, but also to the vessel owning market and the rig owning market and so forth. And I think 20 rigs have eventually gotten suspended. About the same number of boats have gone off hire with Saudi Aramco. And those boats, they migrated their way down into West Africa. Some of them that were locally owned are just there and off hire. But those types of demand issues tends to get worked through globally. It sounds basic, but it's a little game of whack-a-mole. It seems like if it's not happening somewhere else, it's happening elsewhere in the world, and so the boats float to that new area where demand is increasing. And that's a bit of the global diversification benefit that a global player like Tidewater has. But so the demand side, and we'll see more of that. In the UK, I think it was in one of the earlier presentations, they haven't been as friendly for offshore activity, so that's sending some boats down into the Mediterranean, over to Norway, down to Brazil, and so forth. So we'll see that type of shuffling, which definitely has an impact on the supply and demand imbalance, but the temporal aspect of it is much, much shorter than it is for the supply curve. So the supply curve is what I tend to focus on a lot.
So maybe building on that, I intended to ask you, when we might start to see some ordering. You referenced some news announced, at least I saw it this morning, that there was an order for at least 4 new PSVs. But when do you think we may start to see, and I know that you've got a really interesting slide in your IR deck that kind of shows new build economics, but maybe when do you feel we could start to see maybe more material ordering of new builds?
I don't know. I mean, I'm never surprised by what I would characterize as the lack of financial discipline in the shipping industry. It's got 800 years of history and 800 years of cycles for that reason. But I've watched it closely, and so the 4 + 2 I think is the way it was characterized. Now, I don't have any more information than what was publicized, but to me, it's not economic to order a new boat today. So for me, when I see ordering, I see that it'll happen. I know it will happen. But I don't know that it's going to happen like we saw from 2009 to 2014. And then there are still a few reasons for that. One is, for me, when I think about the new build economics today, to me, the boat that would be favored around the world and in most geographies is a boat that costs closer to $65 million. And that's on average. It would be higher in Brazil, probably higher in Norway, perhaps less in China, as we've seen. But for the most part, $65 million is the base price that we've been working with. And that means you're going to need a substantially higher day rate than what we're seeing prevailing today. So from my perspective, I just don't see any reason to build. And I don't think the industry benefits from building at all. And I'll go through that in just a minute. But some of the earlier slides from the good people over at Rystad and D&B showed the fact that this industry has always been envisioned, the offshore hydrocarbon industry. It's always been envisioned as one that perpetually grows. And so if you do order a few boats and you tend to get it at the wrong point in the cycle, well, shame on you. You probably didn't optimize your investment decision, but you didn't lose everything. And in today's world, when you're looking at an offshore hydrocarbon curve that could be rolling over in 2030, you have to ask yourself, what's the life of that boat? Is it really 30 years? Is it really 20 years? And so from my perspective, there are a few things other than just the economics that result in me not believing that the supply response that we've seen in other cycles will be the same that we see in this cycle. One is the economics just aren't there today. The second one is, what is the life of an offshore supply vessel? I do believe that we're going to see a lot of offshore activity in the world as we go even into 2040 and 2050, but that doesn't mean you need more vessels to accomplish it. And so therefore, if you're building a vessel today, you are focused on obsoleting other vessels. And one of the problems with this industry is there is almost a barrier to exit. These boats don't go away, and so it puts pressure on the rate scale up and down the vessel spectrum. And and then the other two things that I would well, there's three things I would add to it. One is because of the social mores that are out there today, and we certainly see this in areas like Norway, and to some degree the northeastern United States. We don't see it everywhere around the world. The world isn't on the same page as it relates to the energy transition. But if people are looking for an alternative fuel source for these vessels, and most of them are, especially in Norway, then if you're building a boat today and your only option is diesel technology, you've got to bake in a $15 to $20 million retrofit 5-10 years from now, and that destroys the economics. And so even if you think that your boat that you're going to build today is going to be one of the last OSVs working in 2090 or whenever all of this goes away, which is who knows when, that means that you're going to have to retrofit your vessel as far as an engine technology goes, and in order to remain competitive. And that just throws more capex into the equation and destroys the economics based on the prevailing rates today. And then the last two things I would say is, there's still a lot of good institutional memory in this room in particular, but in the financing community in general, about what the industry went through call it started in 2006, but really from 2009 to 2014, and how much value was destroyed by overbuilding. And so the lending into this space has not been as aggressive as it has been in this stage of other cycles. So even though we're in the early stages of this recovery, normally we would see a lot more aggressiveness from capital providers into the space, and we're not seeing that today. And the last thing that I'll add is just, the only thing worse than the ship owning business is the shipbuilding business, and that industry got decimated as well. And so there's just not as many shipyards as there were 5 and 10 years ago.
So if we look forward now, we touched earlier on sort of consolidation. Is that high on the agenda now? Are you focused on additional consolidation? Does the industry need more consolidation? And if so, what areas are you focused on?
So from my perspective, this industry is highly fragmented and will forever be highly fragmented. I am not going to do anything to reduce its fragmentation. I don't have that much capital. And so that, when I think about consolidation, I do it to leverage the economies of scale that I was talking about earlier, the efficient shore-based infrastructure, some of the supplier relationships and things like that. So from my perspective, to the extent that I can get a disproportionate share of a vessel class, or a lock in a geographic region, or a good solid customer relationship over multiple geographies. That's what I do with the acquisitions. At the same time, I'm also managing the life of the fleet and making sure that the earnings capacity of the fleet as a whole is in good shape. So, I don't see the need to build today. I don't see the need to delever today. Then I do look for opportunities to get vessels at a reasonable price that I think could add value to my shareholders. Based on all of the things that I think will be talked about in this conference the next couple of days, I think that this industry has a really strong 24 months ahead of it. And so there's going to be opportunity to make a tremendous amount of money. I can make a lot of money with the 200 boats that I have. I don't need 300. If I can get another 100 at the right price, I would do it because I have the economies of scale to leverage it. So, and I would look for, a disproportionate share of a boat class or geography or a customer relationship in order to justify it. But it's not from a defragmentation perspective that I look at it.
Energy transition, of course, is an important theme. How are you preparing Tidewater for the energy transition? And I guess, are you also seeing any major shifts in the way your customers are approaching the transition?
Yeah, I would, the world isn't on the same page as it relates to the energy transition. So when we visit our customers in Norway, they're leaning hard into the transition, and they will subsidize the transition. And they will look for alternative technologies and hybrid technologies like we see prevailing in that market today. And that's a wonderful thing. And anything offshore that requires more boats, I'm all in favor of. I think the world is going to be short of energy globally, quite frankly. And so I want people to invest as much of hydrocarbons and renewables as they can. Personally, that's my belief, but also think it's great for my business because we're a ship operator. And so I think that you'll see Tidewater continue to look into opportunities to expand into offshore renewables. Honestly, over the past 5 years and even over the past 10 years, I just haven't seen it as economic. It never made my return hurdles, so I never wanted to do it. I couldn't figure out how other people were doing it, quite frankly. But it's a shipping industry at its core, and so it will go through cycles. And there will be a point when we can pick up some boats and hopefully create a really nice entry point into the renewables, and we'll definitely do that. And hopefully that sector will get some capital discipline, and as a result, we will continue to grow into that sector. So I'm excited about offshore activity in its broadest sense, in the energy sense. And we'll continue to look for ways to play into that.
It's a Marine Money Conference, after all. I saved kind of this towards the end here, but I guess, how has the way that you allocate capital evolved in, say, the past 5 years? And, looking at the capital structure today, how do you want to position that for the future Tidewater?
So early in while we were still in the downturn phase. So this was prior to 2022, Colin. We were being very conservative, and part of it was dictated by our investors who were still not confident in the recovery, and so they wanted to make sure that we maintained a very diligent leverage ratio. And that's why when we did the acquisitions that we did, they were predominantly equity, and then we paid them down and did the next deal. Okay? And I think that we earned their trust through a couple of good deals, well-priced, well-managed, well-integrated, kept the balance sheet in good shape. So when we did the last deal, it was certainly heavily levered, and in fact, it was 100% levered. And so from that perspective, we did take on some debt. But we did it at a time when the cycle was showing its robustness, and the duration and the durability of the cycle was getting better appreciated. And from my perspective, the way I think about debt is not typical, because I don't use the ratios that a lot of people talk about. I think about it in terms of how many quarters of cash flow does it take me to get back down to cash flow break even. And so we use 6 quarters. And maybe you can say that means 1.5 times EBITDA leverage, but just the way I think about it is, all right, if something goes bad, and in this industry, things will go bad from time to time, I want to be able to pay off my debt with my contract cover, my liquidation of working capital, and some selling of some smaller, older boats. And so I tend to still run fairly conservatively from that perspective. But as the market continues to mature, as the cycle continues to mature, I'm still in a debt capital structure that I would characterize as kind of transition oriented, like a lot of bridge debt, short-term debt. And so moving it into more of an unsecured capital structure with more staggered maturities, bringing in a large revolver to help buffer any downturn. That's what I think about when I think about an ideal capital structure for a cyclical business, and that's what I look to do over the next couple of years. Obviously, we're still holding a lot of cash. I think we've got $300 million worth of cash, mainly because we don't really have an adequately sized revolver. I think we get an adequately sized revolver, we get a more manageable kind of unsecured capital structure, we can let that number come down to a more natural cash level.
Quintin, with that, I just want to say thank you for your time and for your insights.
Oh, thank you. Pleasure to be here.